Hello, friends. Welcome to Nirmal Bang. Today, we are going to put the focus of our conversation on the debt market. There is a new debt issue which is coming into the town. There are a lot of innovations happening in that. To talk about all of that, let me today welcome the senior EVP and head of fixed income of ICICI Prudential Life Insurance, Mr. Arun Srinivasan. Arun sir,
Thank you,
welcome to the show.
Piyush.
And
Thank you
now,
so much, Piyush.
before actually we go to our discussion, let me tell our viewers what actually ICICI Prudential is doing. They're launching Constant Maturity Fund, which is the first of its kind in the life insurance market. They basically are providing the sort of flexibility for the investors to really switch from the funds, also providing them benefit of constant maturity. Let's recall that we are at the end of interest rate cycle, interest increase cycle. So one complete cycle is ending, and now a lot of focus is actually is going towards expectation of increase in the bond returns, perhaps a sweet spot. So at this opportune time, perhaps this fund is something which is going to really garner a lot of attention. From the perspective of when the fund is going to open for subscription, from May 15, the fund basically has already opened for subscription. So you actually can look at the fund. And from the perspective of what all the fund is going to offer, how it is standing out in the market, what is the new innovation which is happening here. Let's now take the conversation. Arun sir, first of all, we all are curious to know what is this constant maturity and how our viewers should really take a look at this new innovation and why it is first of its kind in life insurance.
Okay, great. Thanks, Piyush, for the question. I'll just take it one step behind. So basically, life insurance companies have innovated a lot when it came to equity plans. That's purely because, along with the life cover, I help you create wealth. And for example, we were innovators when it came to the launch of the ESG fund and the hybrid funds and the balance advantage funds on the life insurance space. But one thing, Piyush, which came out very clearly from my policyholders and distributors is like we've innovated on the equity side. Can we innovate something on the fixed income side? Because you've created wealth, you helped somebody create wealth. I'm now 40, 45, say, and I now want to preserve that wealth for the next 10 years with a life cover. And that's when we realized it that yes, on the fixed income side, life insurance companies haven't innovated too much. So we have innovated when it came onto the on the traditional space by launching the gift, which is a guaranteed income plan. We innovated when it came to annuities, immediate annuity, deferred annuities. But on the ULIP side, we didn't innovate much on the fixed income side. So that's when this whole constant maturity fund comes. So I'll tell you what exactly is constant maturity fund, and then basically run as to why are we launching it now. So a constant maturity fund is basically a fund wherein a fund manager will run a maturity between 9 years and 11 years maturity of paper at any point of time. So basically, this fund will be running an average maturity of 10 years, well suited to capture the peak of interest rates which you just alluded to. This fund is going to be invested in average 10-year maturity of government securities, state development loans, and corporate bonds. Obviously, it will have a much higher exposure to government securities and state development loans than corporate bonds because I'm not so comfortable in the corporate bond spreads at this point of time. And why the timing? So, Piyush, this fund we were contemplating for the last 6 months or so, but we were not sure ourselves on the interest rate trajectory. We didn't want to launch a fund, say 6 months or a year back, and then you suddenly saw aggressive rate hikes
So you were,
from CI.
I would,
And I
I
think
would jump in, I would jump and say that you're waiting for the RBI governor to say that I'm pausing.
I think he did say that. He did say that in the last policy, and but obviously he reiterated that it's a pause and not a pivot. And I think that is our view too. And we were one of the few guys who actually talked about it in post the February policy, where we were of the camp that RBI has done with its rate hike. The reason is because market was getting influenced with what is happening in the Fed and other global economies. But all things said and done, we are now at the peak. So we are actually saying it openly that we are at the peak of interest rates. But also mind it, we are also saying that we are not expecting an aggressive rate cut anywhere in this calendar year. In our opinion, the first rate cut, whether by the Fed or by RBI, happens only in Jan, Feb, March. So how do I capture it? So my rates have gone up. My RBI has increased rates by almost 250 basis points from the peak of pandemic. The absolute rates are very, very attractive. If I have to play from an interest rate cut scenario, what better way to do it than to play from a fund which is going to be running a more duration of 6 to 7 years, wherein the average maturity is closer to 10 years. I get the best of a fall in interest rate. The very fact that we have had no NPAs in the last 23 years of managing money in ICICI Prudential Life actually ensures that the portfolio remains solid, and we will continue to use the same logic in this fund also. So it's best suited for one, play the interest rate cycle. Number two, you get a good carry, and number three, you are able to preserve your wealth. And tomorrow, say 3 years, 5 years down the line, because I'm a long term player and the money will remain with me for 5 years to 10 years, the policyholder has the opportunity to move out of the fund to any of the other 17 options I give him on the equity side. So that's without any tax implication. So that's the USP of this fund, Piyush.
So there's one more part here, like from a viewer's perspective, because they would be really thinking, as we all know, right? The equity is something which like everybody claims of understanding it, and when it comes to the debt, the viewers, investors, they try to understand more. So from their perspective, uh, when we say that constant maturity is something which is first of its kind, um,
Yes.
in the industry, there is no other constant maturity fund.
No, no. In the life insurance space, we are the first guys to launch a constant maturity fund.
Okay, so that's something unique about it. Now, from the perspective of post-tax yield, what is sort of expectation you would think for the investors?
See, Piyush, whenever as a life insurance company, we look at long term. When I say long term, I'm talking about 5 years to 10-year horizon because the money
Sure,
will be with me for that tenure.
absolutely.
And what we've realized is, the way I've been managing money for 26 years now, 18 years with ICICI Prudential Life, whenever somebody remains invested over a period of time, especially in our markets with all the volatility, you can easily generate a higher single digit, lower double digit type return over a 5 year, 10-year horizon with the advantage of switching asset classes as and when you prefer. So
Right.
I'm not. So we are here to say we are not here to say we're going to make a big double digit, high double digit return and all. No, we're talking about a scenario wherein I make a higher single digit, lower double digit return, but on a consistent basis. That's most
Right.
important.
I think anybody who's investing in that, I think, would be looking at that only, else they will have to go to equities or other asset class. But from that perspective, will it be fair to expect or say that this time there are twin engines which will fire for bonds or debt as an asset class? One is the traditional sort of hold and get the benefits of yield, and the second is capital appreciation possibility, because we are at the point of a cycle where the bonds will rally and keep on rallying over the next many quarters.
Piyush, you have said it perfectly. That's exactly the whole genesis of this fund. Carry the traditional way and capital gains when there are rate cuts. So it's a best combination of both of them.
Absolutely. Now, from the perspective of right now where we are, how actually you're looking at the markets? And I'm asking you, I'm taking a step back here and trying to take your view. We are at a point where we are saying that yes, this is absolutely a sweet time for bonds, and bonds have been doing well over the last 2 months at least. We are seeing equities have been outperforming, then underperforming versus some Asia, but broadly they have been doing all good. Gold, precious metals doing brilliantly, continue to remain bullish. So I am seeing every asset class is outperforming. When I go to real estate and I talk to everybody, everything is firing up. So it appears like it's huge money liquidity situation. So what is your own expectation right now on the markets?
Okay. So Piyush, in my view, let me first talk about fixed income and then get into others because being I'm in the fixed income forte. Rate
No,
hikes have happened.
my question is just to clarify. My question is only from a sense on whether the markets actually are going to continue sort of give this sort of positivity to the investors as they move across many three, four, five,
Yes,
six quarters, and then insurance is a long term game.
exactly. So Piyush, see, every asset class will go through its ups and downs, and that's got to do with whether it's equity market or gold or any commodities for that matter. There will be ups and downs. You look at more from a risk reward matrix. So right now, fixed income market is well poised from a risk reward matrix. The aggressive rate hikes which I talked about earlier is done. 250 basis points in India, almost 500 basis points in US. Inflation saw numbers in US which we have not seen in 40 years. So keeping all this in mind, you had an impact on inflation. So the only way to counter inflation is by aggressive rate hikes. Now, when there is a high inflation and aggressive rate hikes, it would have an impact on the more volatile asset classes. So the best way for a policyholder to play right now is like obviously, so gold has rallied, keeping in mind the way people looked at the US dollar. But at the same point of time, equity markets rallied because of the excess liquidity which has been pumped in by various central banks. So now, for the next 3 years, 5 years, in my opinion, fixed income markets will rock. I think we are very well poised from a rate angle. And again, it's not going to be you jump into fixed income markets and see a sharp correction in interest rates in the next 3 6 months. Not at all. You're going to be in fixed income market, enjoy the carry of 7% plus, and then play for rate cuts in the new calendar year. So from that angle, I think that's the reason why I feel next 3 years, 5 years is going to be fixed income markets. Again,
Absolutely.
not camp to see means major corrections in other asset classes, but clearly fixed income is going to outperform the other asset classes.
Yeah, when actually that actually starts producing very strong returns, it usually makes sense, a lot of sense to really give it a lot of importance. I have two questions. We talked about the sort of post-tax yield, you answered on that. There's another one which I want to get a clarity for our viewers, and that basically is the tax efficiency here. As basically around 2.5 lakhs, is that is something which is a sort of tax efficiency limit? Please give some more clarity so that our viewers can really understand what sort of planning they can do.
Perfect. So Piyush, any amount less than 2.5 lakhs is tax free, whether you buy it in equity or fixed income. Anything above 2.5 lakhs, I get the indexation benefit. 20% tax with indexation benefit. There is no other avenue today in India which gives you the indexation benefit other than insurance companies. So for anybody below 2.5 lakhs, it's a no-brainer. It's tax-free. But for anybody who's going to put in beyond 2.5 lakhs, you have indexation benefit. Looking at the present CPI of closer to 6-7%, your actual tax incidence will actually be much lower now.
Right. And allow me to ask you this name question, but for our viewers, many of our viewers, I think, would not be able to understand indexation benefit also. So if we actually sort of simplify it, indexation benefit, how much sort of it helps on their returns?
See, if I look at, suppose I land up, I put in 100 rupees, I make a say 10% return. My entire 10% is not taxed. So assuming inflation is at 6%, I pay 20% only on the 4 rupees, 4% extra gain which I made. That's how it works. So I remove out the inflation aspect out of it. So from an India centric perspective, that's a big gain.
Absolutely a big gain, and anything which is tax saving to such a large Indian middle class, I think is a welcome bonanza.
Exactly, Piyush.
So, apart from this, from the perspective of the fund actually has already opened from May 15, and we actually are talking about a lock-in period here. What is sort of lock-in period, and what is the
No
rationale
lock-in,
for the lock-in period?
no lock-in period. So how it works is, say I'm a life insurance company. So if you want to get into the NFO, that is till the 20th of May, you need to buy a brand new policy. After the 28th of May, any of my old policy holders can shift into this fund. So the
Oh, very
NFO
nice.
is kept, yeah. So the NFO is kept only for the new policy holders who will jump in between the 15th of May till the 28th of May. But after the 20th of May, 29th of May, when the fund is open to everybody else, it becomes one of my with along with the other 17 funds. So even my existing policy holders who are there in equity or any of the other funds of mine can shift into this fund.
Oh, that's I think which is something very good. So it only requires basically you to take an insurance policy if you are a
Yes,
new sort of insurance policy holder. If you're an existing policy holder, you can actually shift to this fund.
exactly. After the 28th of May.
20th of May.
Yes.
Fine. And as we sort of come to the end of this conversation, let me sort of squeeze in one or two questions here. from from the perspective of since you look at the fixed income market so closely, and I'm asking this question only from one point of view, is that right now, from the perspective of long tenor bonds, is that something which, as an insurance fund house, you have a more sort of conviction for this calendar year, and perhaps you actually are going to look at the shorter tenor or the corporate bonds, maybe 7, 8, or 10 months down the line with a sort of shift into that spread? Is it more like a dynamic fund approach? Because this fund would be catering only to a sort of 10-year average horizon.
Yes.
So next year, basically, what our viewers should be really planning, or they should not be thinking anything.
So Piyush, I'll break it into my answer into two parts. One, right now, what I feel is the best curve. So Piyush, again, when we discussed about the constant maturity fund, I had an option of 5 years, 10 years, or 15 years. The 10-year space was the juiciest. The curve is flat today because of liquidity and other reasons. The curve is flat, and the 10-year is one which gives you the best risk reward as compared to buying a 15-year or a 20-year exposure. So right now, the 10-year seems to be the best on the curve. If you ask me my view, 6 months, 1 year down the line, the curve will get steeper. So 1 year to 10-year will outperform. 11-year onwards, right up to the 40 years, I expect the curve to get steeper. And it is a normal scenario whenever there are rate cuts and liquidity comes back into the system, your shorter end of the curve starts coming down. So your 1 cross 10 looks attractive, but your 10 cross 40, if I can use those, the jargons, the 40-year G-Secs and all yields will either remain anchored or move up a little more. But the 10-year and below will do the best on the curve. So right now, for the next 1 year to 2 years, I feel people to remain invested in the 10-year space. Once the curve gets steeper, that's when you increase your maturity and go up to the 15-year space or so. That's when I might come out with a new plan in 15 years at that point of time.
Well, Arun sir, thanks a lot for showing patience and explaining those small things to our viewers to really understand the fund very nicely. Indeed, it's a unique innovation. Also gives our viewers, investors across India an opportunity to really participate in the bond run-up, also sort of insurance, long-term planning, and then also participate in terms of capital appreciation opportunity also. So perhaps a very unique instrument, and I think we would like to extend all the best wishes to you.
Thank you so much, Piyush. Thank you so much for having me on your show.
And dear viewers, with that, I think we come to the end of this conversation. Hope you enjoyed it.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.